Okay. Thank you for having us. So I'm instructed to stay here. I have urgency to jump in front of the screen. I'll try to resist that urge. So this is joint work with Marco and Julian, who are both here. We are very grateful for the money, let's call it as it is, we are receiving from the Norwegian Finance Initiative. And the title of the paper is Corporate Governance Through Voice and Exit, Evidence from Standard Life Investments. And this study does exactly what it says on the tin. It's about standard life investments. So to give you a sense, okay, no. Okay, this is not, okay. So this is not moving, but this is moving. Okay, so we have focused recently a lot of our interest on activist hedge funds. And one problem you might say is that while activist hedge funds are terribly interesting and they have a lot of impact, they're really tiny, okay? So if you look at global assets under management for the global asset management industry, it's about 0.6%. So this is important, but you know, it's not the bulk. The bulk is what is being actively managed by active asset managers. And tomorrow we may still have a paper about the passive investors and their impact on corporate governance, but our paper really is, if you like, about the lion's share, so the active asset management industry and how they interact with the firms that they own. Now, we're looking at a UK-based asset manager. Why? For a number of reasons. And one reason Bernie a few years ago described in short, Britain presents a model of what US security markets might look if US institutional holdings continue to grow and with many fewer legal barriers to institutional investor participation in corporate governance. So if you will, we're looking at the UK, but we are really looking at global institutions, and it might as well be in the United States. So Standard Life we find very interesting because it's among the largest 50 asset managers in the world. In the UK, after a recent merger, it's now the third largest. It's a mostly active manager, and it provides to us an opportunity for a unique view on the role of stewardship in active asset managers. Just to give you a sense, now this is really difficult because they're not synchronized. So Standard Life and Aberdeen have recently merged to form the entity that we're now analyzing. So we are talking about one of the 30 largest global asset managers. And while they are all complex and different and difficult to understand, one thing that we believe is important they share is that virtually all of them have what I'm calling here a centralized stewardship function, where the interaction, let's say, on the corporate governance side with the portfolio firms that the asset manager holds is centralized. So we are really after the effect of this centralized governance function, okay? Now, what do we know about this? And this is a paper that we all know and we are all citing. It turns out we know very little about it. We have little direct knowledge regarding how institutional investors engage with portfolio companies, as many of these interactions occur behind the scenes. Unless institutions publicly express their approval or disapproval of a firm's activities or management, their preferences in private engagement with portfolio firms are not observable. Now, it turns out that the institutions themselves, no surprise, don't necessarily know themselves much better what they are doing, which is one reason why they are giving us presumably access to their data. Yeah? So many in the industry seek a better understanding of their own industry. So we are trying to lift the wheel on what is going on here. How do you do this? By using proprietary data, which is exactly what we're doing. So Standard Life have given us all their effectively internal data. Let me just focus on one piece here. So we have the complete communications data between the portfolio firms that the asset manager owns and the centralized governance function of the asset manager. So who said what to whom when, and as you can imagine, this is, even if it's very well structured,
there's like a phone call that keep records of them?
There are phone calls in there. Yeah, we don't have the phone calls, but we have transcripts. So it's a lot of data. And we combine all this data with standard databases. And quite frankly, when people say, you know, oh, I'm presenting preliminary work, and then over lunch you say, well, how preliminary is it? And yeah, it's forthcoming QJE. Ours is not forthcoming in QJE just yet, so it's really preliminary, and the reason for this is that it has taken us extremely long time to put all of this together. So you're seeing, you know, some glimpses of what we think, you know, will be the interesting results we can actually find. So eventually, our contribution should be to answer at least these three research questions. So first, to what extent is engagement related to fund managers trading of assets? And, you know, as an alternative view, to what extent is it related to long-term holdings and trust and commitment, which is a quite different view of governance that isn't just, you know, supporting the trading function. The second question we want to address is, can we actually lift the veil on whether exit and voice are substitutes or complements, as has been argued, or do they actually matter at all? And the third question is, does the investment performance of buy-side research, so purely internal research compared to sell-side research, relate to governance and stewardship? Now, to give you a sense of how this asset manager or how an asset manager looks like, if you held all stocks in the US and your portfolio only had turnover because of natural life and death situations of firms, so if you owned all firms on CRISP, your annual turnover would be about 7%. If you look at actively managed mutual funds in the US, you know, it's 80 or 90% of trading, so there's a lot of turnover. Our asset manager at aggregate level has about 30%, and the funds themselves about 50%. So think about a holding period of 2 years. Neither very short term nor very long term. It's certainly not 10 years. Okay? Now, how should you think about an asset manager? This is, you know, as simple as we can possibly make it. These are complex organizations, but we think they all have essentially at least these three building blocks. They are the fund managers. They are the buy-side analysts that generate research to be used by the fund managers, and there is a centralized stewardship function. Now, all of this here interacts with the portfolio company, and then, of course, the portfolio company interacts with the rest of financial markets, other analysts, and so on and so on. Now, who does what in interacting with the firm? What Standard Life do is, roughly speaking, this. The centralized stewardship function is in charge of remuneration, CSR, SRI, ESG, whatever you want to call it, appointing the chairman and non-executive directors. The CEO, you know, is split between them and the fund managers and the analysts on the other side. So think about, you know, the centralized stewardship function being on the left-hand side of the corridor, and these guys, the fund managers, being on the right-hand side of the corridor. They meet once a week, yeah, at least. So they talk a lot. And the fund managers are, if you like, in charge of the big things, so delisting, rights issues, divestitures, M&A, and selling the stake that they're holding. Yeah? But there is some share of who does what with respect to the firm. Now, a highly stylized process to think about, you know, how do you get from aggregated governance to actually buying or selling the stake in a firm, it would look like this, that the centralized stewardship function forms an opinion about the quality and, you know, the type of governance of the firm, passes this information on to the internal analyst. The internal analyst issues in return a buy, hold, sell recommendation, which is consumed only, because it's internal, so it's buy side, only consumed by the fund managers, and the fund managers in turn issue themselves a buy, hold, sell decision for the stake that they're holding. Now, the analysts are frequently fund managers, and fund managers are frequently analysts inside this asset manager. So you can aggregate these three, but there's certainly a flow of information in this direction. Okay? And they talk frequently, so this is not hypothetical at all. Now, what does the centralized stewardship function actually do? So they interact with firms, and just to give you an idea of what they do, this is data aggregated at the quarterly level, so these are, you know, number of contacts that they have with all of their portfolio firms every quarter. So multiply the figure by 4, and then you have basically the annual workload. So per quarter there are between 100, 200 contacts, because they discuss more than one issue. So for example, compensation and a voting type of problem for the next general meeting per contact, the number of issues that they discuss per quarter is somewhere between 100 and 300. What do they mostly discuss with the target firms? More than 50% of their issues that they discuss involve compensation issues, board structure issues, and ownership and voting issues. Everything else, including socially responsible investment, which is important, is less important, just by raw counts. Okay? Now, to us, very interesting feature, which is exactly the point of having proprietary data, is that one thing that they do is they issue what they call so-called governance health warnings. Now, governance health warnings are internal flags that firms receive, so portfolio firms receive from the stewardship function, and they receive these flags at any given time. 30 to 80 companies out of 350 to 700 UK firms that they hold are flagged in this fashion. So they observe this internally, and what might lead to a governance health warning being raised? Well, something related to auditing, the block holders, conflicts of interest, many of the board issues that they care about, compensation and so on. Importantly, not performance. Performance is something else. Okay? So this is the stewardship function that monitors, if you like, the quality of governance of the target firms, and if they're unhappy, they will flag a firm with a governance health warning. The firm doesn't receive this information, but the internal fund managers obviously do. Okay? So an important way for us to start looking at might governance matter for exit and voice is to analyze these governance health warnings that are important events. Now, what are these governance health warning episodes, possibly related to? So what explains, my dependent variable here is, are you subject to a governance health warning at any given time? Just to understand the data, we're looking at here now at aggregate holdings of the asset manager across all the 100 to 200 funds that they run at any given time, aggregated at the monthly level for the entire sample period for all UK listed stocks that they own. Everything else is separate. And there are two things that are potentially interesting here. What issues or what triggers such a governance health warning? First, the fact that the stewardship function is actually talking to the firm. So voice seems to lead potentially to dissatisfaction later. So there will be a trigger for voice, obviously, in the first place. Secondly, underperformance in the last month or in the last year also seems to lead to or be related to, no causality here yet, for a governance health warning. Now, if these are potentially important events, so these governance health warnings are potentially important events, this is event study evidence just showing you what happens to the intensity of communication around these events. Yeah, and what you see is this very strong spike in how many times the asset manager talks to the firm and how many issues they actually talk about. And afterwards, it doesn't quite fall back down to the previous level. So there is a sense of, if you think about activist hedge funds and the way they engage with the firm, there is a sense of this here, even if the setting is very different. Because an activist may own 3 stocks or 4 stocks or 7 stocks at any one point in time. This is 700 stocks, right? So it's a completely different level of engagement that we're talking about. Now, next building block, what about the buy-side researchers? So what about the internal analysts that are producing research only for consumption by the fund managers of Standard Life itself? If you compare them, just eyeballing, how do they compare with sell-side research, which you are familiar with from IBIS? So, what's the percentage of buy recommendations, hold recommendations, sell recommendations? What you see here very clearly after the financial crisis from 2008 onwards, the buy recommendations of Standard Life, those that are consumed internally, are substantially more hawkish. So they are less likely, significantly less likely to be buys, and they're significantly more likely to be sells. Yeah? So possibly these are more realistic analyst recommendations. And we know this from other papers that have used proprietary buy-side recommendations as well. So it seems to make sense. Now, next step, if you like, the analysts, and remember the analysts in some cases are the fund managers, and do the fund managers, do they all listen to what the stewardship function has to say? And the answer seems to be definitely yes. So this is event study evidence that is centered on the event of a new governance health warning being switched on, and I'm restricting the data to minus 12 months before and minus 12 months after. So what you see here is as soon as the governance health warning switches on, the analysts have a vastly higher probability of issuing sell recommendations. The analysts have a vastly lower probability of issuing buy recommendations, and the aggregate stake, this is not the individual fund, but you find the same for the individual funds, but the aggregate stake of the asset manager significantly falls after the health warning. Okay, so not sure about causality just yet, but you know, the evidence is indicative that yes, analysts and fund managers are reacting to the opinions that are formed exclusively on governance, if you like, of the stewardship function. Okay, so the sells increase by 44%, the buys decrease by 13%, aggregate holdings decrease by 22%. Okay. Now, next building block, voting against management. So we have data for 6,925 shareholder meetings where Standard Life cast votes and bothered to do so. Now, just two metrics here. First, the percentage of meetings where they vote against one or more management recommendations. 8% where they do so, they actually vote against, and 12% where they abstain. Our sense is that the abstentions are economically pretty similar to actually voting against. Yeah, so abstaining is the first step, voting against is the second step, and these are fairly frequent. 12%, okay, of shareholder meetings. If you look at the time series, you see again that the bite, you know, is getting stronger. Pre-financial crisis comparing post-financial crisis, so the likelihood that you will vote against management on a particular issue that could be compensation, could be SRI, could be board structure, goes up over time. Yeah, and it goes up significantly. Now, if you decide to vote against management, why would you do so? And this is, the first column shows you with a dependent variable, did you actually vote against management for the entire sample? And first, you're more likely to vote against management for large firms, okay, and controlling for a lot of other stuff. And you're more likely, no surprise, to vote against management if the stewardship function has previously, all values are lagged here, issued one of these internal flags for bad governance. Okay? Same applies for abstentions. So abstentions are meaningful. And what columns 3 to 8 show basically is if you have voted against management, what would be the issue on which you voted against management on? And keeping in mind that these are presumably votes cast directly or indirectly by the stewardship function, it should relate to their mandate. And everything makes sense because the issues where they actually vote against management are related to compensation and to board, not to the other issues where the fund managers are actually in charge. Okay? So the effect is concentrated on management proposals that are related to board compensation and to board composition and executive compensation, and this is perfectly in line with the standard, with the mandate of stewardship that they actually have. Yeah? So everything kind of makes sense and there seems to be impact. Now, again, event study evidence to start building an argument, does it actually matter for exit, whether you are happy or unhappy with return? What this is showing you is for different definitions of exit, because we're not sure, you know, what exit really means. For the survey papers, it's easy to say, do you exit? And the institutional investors say yes. So we say exit could mean you sell everything, exit could mean you sell a lot, exit could mean you sell almost everything. Doesn't really seem to matter, so these are just different definitions of exit. What the red line is showing you is basically relative to the blue line, a diff in diff. what's the probability of you exiting, according to these 1, 2, 3, 4 different definitions of exit, conditional on you having voted against management's proposal at one of these meetings. And what you see very clearly, what you would see in the regressions that are not on the slide, the probability that you actually exit after one of these votes against management significantly increases, no matter how we define exit. Okay? Having said this, we, after having looked at a lot of this data, think the explanation is probably more subtle. Why you exit and why you may want to keep the stock. After talking to fund managers, we already know that there is enormous heterogeneity between fund managers, how they think about, when you should exit. Some think that, yes, if governance is, bad, this is a great opportunity to sell because there will be problems down the road. Others are contrarians and believe that when the governance problems arise is precisely when you should buy because this will be where future alpha can be found, hopefully. Yeah. So when you actually look at what other institutional investors say, it's not so simple. Yeah. So should we expect active owners to exit when voice fails? TIA says no. We believe that divestment is an ineffective means of improving corporate behavior. By relinquishing ownership in companies, we obviously lose the ability to influence them. Yeah? So the story of how you exit and why, if you're unhappy with governance, may be a lot more nuanced than, and we're just starting to scratch the surface here. Okay? So final piece of evidence, and then I'll stop. We don't have performance results yet, but we are obviously all interested in performance. So to give you a sense of what we think we are going to find going forward is, we're looking here at event study evidence of when the internal analysts change their minds. Okay, so we're looking at recommendation changes, buy to hold to sell, so the downgrades, and the sell to hold, sell to buy to hold to buy, the upgrades in analyst opinions. And what you find here, for example, the hold to sell, which is a very strong signal, you find this very large negative and significant abnormal return around the analyst recommendation change for 1 month before and 1 month after the event. You find this even larger one here of minus 10% for a buy switching to a sell. So a cautious interpretation is that the analysts might be processing information that actually matters for generating alpha. And this is very preliminary. Now, more interesting, we think, is that when you split these subsamples, again, the simplest exercise I can show you is I'm simply splitting my downgrades, let's say here, okay, into is the company at the time of the downgrade subject to one of these secret internal flags, the governance health warning. And if governance matters and helps to generate alpha, or if you like, helps to avoid losses by getting out in time, you see that, yes, actually the companies that are subject to a health warning have massive negative returns. Admittedly, it's a small sample, but a first sense of what we may find once we dig deeper compared to those that were not subject to a governance health warning at the time that the analyst actually changed his or her view. And keep in mind, the analysts are reacting to governance health warnings, and the fund managers I showed you are reacting to changes in sell and buy recommendations. Okay, so everything kind of fits together. Now, what we haven't done yet, but what we will do going forward is tell you where outcomes come into play here. So given our history of looking at active engagements by hedge funds, so what we definitely want to look at, are there changes that we can find due to the influence of the active manager, in compensation and acquisitions, takeovers and board changes, and do they matter? I can't tell you yet, but we will be able to tell you in 2 months. So to conclude, to what extent is the engagement, this was our first question, related to fund managers' trading of assets and alternatively, related to long-term holdings, trust and commitment? We are pretty sure that we see a lot of results that, stewardship activity is related to trading. So this definitely matters. We do not know yet whether there is this other element that we are really interested in related to trust and commitment. Can we say something about whether exit and voice are substitutes or complements, or do they matter at all? They seem to matter a lot. So all the evidence that we have so far points in that direction. Over 50% of what the stewardship function does is related to compensation, board composition and voting. The votes against management and abstentions, which seem to be very important as well, they are significantly more likely for companies that have one of these governance health warnings. And the issues that they really care about is compensation and board composition. So we want to look at outcomes there very obviously. Probability of exit is also significantly greater for target companies where the asset manager actually abstained or voted against the firm. So clearly this matters. Third question, again, starting to address it, does the investment performance of Buyside Research relate to governance and stewardship? Well, internal analysts are different from sell-side analysts. That's very clear. We find these very preliminary, but economically very large at normal returns, and the sell recommendations and the buy recommendations are definitely reacting to the information that is being produced by the stewardship function. Okay, so let me stop here. As I said, it's preliminary and we look forward to your comments. Thank you.